Good morning. Welcome everyone to our OakBridge Weekly Market Update. Today we're going to be talking about the S&P 500 earnings reports that came out this week and talk a little bit about that. But welcome everyone. Thank you for tuning in, and we will jump right in. So as you can see from this chart here, this is the S&P 500 profit margin. You can see that we've dipped a little and come back up a little bit. Earnings are still pretty good. They're not as robust as they were a few weeks ago or even a month ago, or especially last year. Just to give you an example, so right now earnings dipped to 12%. Last week, the projection was 12.4%, and a year ago, the projection was 13.3%. So you can see that earnings, as far as earnings growth, has dipped, but nonetheless, we're still positive in the earnings category. And as of Friday, we've had over half of the market reporting for the current S&P 500 earnings, and we're down quarter-to-quarter growth. Right now, we're at 11.9%. We saw a pretty good decline last week from big tech names, mostly. Most of the underperformance was by the Googles of the world and the Netflix and other big tech names that are out there. And the biggest thing that's happening right now with them is that we're just getting some, there's a number of things. US dollar, strong dollars been a real headwind for them. They've been having quite a decline in ad revenue, especially Facebook, as we've been tracking that a little bit. They're really struggling right now to get revenue back to where it was. They're also having a little bit higher operating costs. They have more employees. You'll notice last week that when Elon Musk bought Twitter, one of the first things that he did was he said he was going to cut costs, and he laid off a bunch of people there. So that's kind of indicative of the big tech industry right now, as far as where they're at and what's happening. They're recording losses on newer business. The older business seems to be in place and doesn't seem to be as affected that much. But the management teams are now going to have to look forward and see. They're planning on slowing hiring a little bit, cutting costs, primarily just to protect the profit margins that they have right now. Now, the other flip side of the coin is, however, is that in contrast to technology, consumer discretionary has been quite resilient. And in spite of persistent inflation and a little bit of confidence erosion, especially the auto industry, it's remained very, very good. They've had been able to have higher prices, which has been boosting profits. And hotels and food, interestingly enough, is that even with inflation and with what's been happening in the rising of costs, both of those two have remained fairly steady and fairly robust as far as their operating profits. So the key is from here on out is to see if the companies can defend these profit margins, and looking forward and making sure that they're getting in a position to where they can continue to grow despite what's going on with inflation rates and with the Fed raising interest rates and all of the various headwinds right now that are going on. But all in all, last month was a very good month in the S&P 500. It's one of the better months that we've had for a long, long time. We are still down substantially, but the market has liked some of this good news. It's still up for debate. I hear lots of people saying there are lots of bulls out there that are saying we're going down, down, down. I hear lots of bulls out there saying that we're going up, 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 and lots of bulls out there that are saying we're going down, down, down. So one of the things that we've been talking about here is that, in my opinion, it is good for us to have differing opinions as far as where the markets are going. What that means to me is that if everybody's on the same page as far as where they think that the market's going, what happens with that is a lot of times we either get overbought in the marketplace or oversold in the marketplace. So it exaggerates what's going on. And with a complementary bulls and bears at the same time, both giving us opposite directions in the market, it tends to make the market a little more orderly. It tends to give caution to those that are looking to buy in, it tends to give optimism for those that are looking to have a better price point to buy in at. And so I think that for the next little while, we're just going to kind of see the markets go back and forth based upon this bull and bear philosophy that's going on right now. Anyway, thank you again for tuning in. If you have questions or concerns, please don't hesitate to call us. We're in the middle right now of our fall reviews with everyone. If we haven't called you yet, you're welcome to call in and set a time. But you are on our list, and we'll get you in as soon as we can. And in addition to that, if you have friends or family that you think that might be interested in our weekly podcast, you're welcome to send our link forward to them. Again, thank you for tuning in, and thank you for joining us today.